Hello, it's Joshua here with another edition of Mortgage Clarity. And today we're going to talk about a 2-1 buy down. What is it? How does it work? And does it benefit you or not? So let's start with what it is. So a 2-1 buy down, it's a 30-year fixed rate loan. However, the lender is allowing you to purchase and buy down the interest rate for the first 2 years. So there is a cost associated to this. And the way it typically works is, let's just say you have a 5.5% interest rate and you're going to do the 2-1 buy down. That means for the first 12 months, your interest rate and your payment based on that rate is 3.5%. And then after year one through year two, your interest rate's based at 4.5%. And then from year three forward, it's at your actual rate of 5.5%. So that's how it is. So let's just take a look really quick on how the math is. Because essentially the way this works is the lender is going to calculate how much interest is being lost during that time frame, and then that has to get accounted for. And again, that can be done in multiple ways. It can be either a seller credit that's used to offset that. If you're working with a builder, perhaps the builder builds it into the purchase price and they pay for it, so it's still a seller credit. Or the lender might price it into your interest rate. So whatever the cost of your rate is, that gets adjusted so that the new cost of that rate actually offsets that cost. The important thing to know here is there is a cost that one way or another does impact you. So let's just take a look at some of the math and see how this looks. So in this example here, we have a $500,000 purchase price. We're going to put $100,000 down, so 20% down. And let's just say we have a 5.5% rate with an APR of 5.576. Now this is just hypothetical, but I want to come back to this APR here at the end of the slide. Now, in this scenario, the principal and interest payment of this loan is $2,271 and change. You still your tax and insurance, but this is the loan portion of it. So now let's go ahead and take a look at how the math works. So in year one, because you're doing the 2-1 buy down, your rate's 3.5% on that $400,000. So that means that your principal and interest payment for the first year is $1,796, or roughly a $475 less payment for the first year. That totals up to about $5,600 or $5,700 of interest costs that has to be accounted for, which we'll come back to that again. So now let's go into year two. So now in year two, your rate goes from that 3.5, goes up to 4.5, getting closer to the actual rate of 5.5. And because your rate now is only a 1% difference than a 2% difference, your payment savings is only about $244 a month, which accounts to almost $3,000 difference over a 12-month period. And again, the reason that's $3,000 is so much less than the first year is because you're only a 1% difference in the rate versus a 2% difference. So then when we get down to it at the end of the year three, starting at year three, we total this up and we can see that over the first 2 years, there's about $8,932 of costs that was not paid because we artificially lowered that rate. The actual note rate is still 5.5%. So this is where the seller would have to agree to pay this closing cost, or the interest rate that you're going to get from the lender, it would be adjusted so that the discount fee, let's just say the discount fee on day one was 0, but because you're doing the 2-1 buy down, that discount fee for that rate now becomes $8,932. So you're still paying for it, even with the seller credit. If you negotiate a contract and the seller agrees to pay $9,000 towards your closing costs of what you're using to buy down the rate, keep in mind that even though they're paying for it, you're paying for it because that means they would have accepted a $9,000 lower purchase price to begin with. So the really important thing is you want to know that, because this is where sometimes maybe some deceptive practices maybe or some confusion can be out there. Because the last point we're going to make is look at the APR. It's a 5.5 rate, APR is 5.576, even though you have an additional $9,000 cost on this loan compared to the other one. And the reason you have that is because that cost is being offset by the lower interest rate. So from an APR standpoint, didn't really change anything. And again, this is important because a lender might show you a low interest rate. And if you read the fine print, it might describe that it's a 2-1 buy down and go through this. But a lot of people, particularly when they're online, they're kind of attracted to the rate first. The APR is not your interest rate. The interest rate is. And for more information on that, check out my other video on actually understanding what an APR is. So is a 2-1 buy down a good idea? Again, you are paying for this one way or another. In most cases, I don't think so. Why would a person want to do a 2-1 buy down? Well, you're still required to qualify for the full payment. So there's no advantage to you as a consumer by going with a 2-1 buy down so that you can purchase a price at a higher price point, because you still have to qualify for the fully indexed. So there's no advantage there. But the advantage might be that even though the lender says you qualify at the full index, for the first year or two, you feel that might be a little hard for your household. But you know, perhaps with your job, you're expecting some promotions throughout the future, and later down the line, that higher payment would be more comfortable. That might be a reason why you might choose to do this. But again, it's not to qualify for a higher price, because you have to still qualify at that point. Now, the reason I'm not a very big fan of this particular product in this particular market right now, in particular, is because I think interest rates go lower over time. So if you spend all this money up front to buy down the interest rates, and a year from now, rates drop below where they're currently at, you're going to want to take advantage of a refinance, likely. And so if you do that, you'll have greatly overpaid for your loan, because you would not have been in the loan long enough to recover those costs. You got to be in the loan 2 years to get the full benefit of having bought down the rate. So it's not that it's a bad idea. It's just important to understand how it works and to make sure that the benefit for you is there. And if not, don't be fooled by the low interest rates that sometimes get our attentions. And if we don't read the fine print, we might be getting something that's really not that advantageous. So I hope this helps you. That's what a 2-1 buy down is. If you have additional questions, let me know. If you like this video, hit the like button, subscribe. That helps other people understand or find us online, and also helps you know when we post new material. All right, thank you so much. Have a great day.